I'm Wendy Moran, an assurance partner at McGowen, Hurst, Clark & Smith. There is new revenue recognition accounting guidance that is effective for all non-public companies for years beginning after December 15, 2018. This new guidance requires a 5-step analysis of revenue and additional disclosures. This video discusses Step 4, allocate the transaction price to the performance obligations. Note that this step only applies if there is more than one performance obligation present in the contract. The transaction price should be allocated to each performance obligation in the contract at contract inception on the basis of relative standalone selling price. Allocate the transaction price using the observable price of each good or service, unless standalone selling prices are not readily observable, in which case the company must estimate the standalone selling price. There are two common methods to do this estimation process. One, the adjusted market assessment approach, in which companies refer to competitor prices for similar goods or services and adjust for the company's specific costs and margins. Two, the expected cost plus margin approach, in which the company's cost basis is adjusted to reflect the margin the market would be willing to pay. Standalone selling prices in a contract are not updated after this estimation process occurs. A single good or service may have more than one standalone selling price if the company is willing to sell goods or services at different prices to different customers or in different geographical markets, for example. Therefore, there may be a need to stratify the analysis to determine the standalone selling price for each class of customer, geography, or market. Discounts within contracts also need to be allocated. Discounts should be proportionally allocated to all performance obligations in the contract. However, a discount can be allocated entirely to one or more, but not all performance obligations, if the company regularly discounts just one of the performance obligations. Companies should allocate variable consideration amounts entirely to a performance obligation or to a distinct good or service that forms part of the performance obligation when the following criteria are met. Variable payment relates specifically to efforts to satisfy the performance obligation or transfer the distinct goods or service. Allocating the variable amount entirely to the performance obligation or the distinct good or service is consistent with the allocation objective. That is, it depicts the amount of consideration to which the company expects to be entitled to in exchange for transferring the promised good or service to the customer. I hope you find this video helpful as you begin to evaluate the impact of the new revenue recognition standard. Please see our other videos on revenue recognition and contact your accounting professional or us here at McGowen, Hurst, Clark & Smith for additional information or advice.